What does overfitting mean when you're backtesting strategies? Overfitting and backtesting happens when a strategy is too closely adjusted to match past data, making it look very effective in hindsight. However, because it's so finely tuned to past data, it might not perform well with new, unknown, and future data. After all, you want to have strategy that can predict an unknown future, not what's happened in the past. Overfitting's the same as memorizing answers for a test based on a study guide and then failing on different questions in the actual exam. How can I identify overfitting in my backtesting results? Overfitting and backtesting happens when your trading strategy looks perfect on past data but doesn't do well in real trading. If you get results like the equity curve on the screen, you might want to check if your backtest settings are correct or the rules fit the past too closely. It's most likely too good to be true. To identify overfitting, check if your strategy performs exceptionally well on historical data but poorly on new, unseen data. If it does, it might be overfitting, meaning it's too finely tuned to past data and less likely to be adaptable to new market conditions. Why is overfitting a problem in trading strategies? Overfitting in trading strategies is a problem because it makes a strategy look effective in past conditions but unreliable in real trading. Essentially, the strategy learns to predict past data, including random noise and specific details, rather than predicting new and unknown data. This often leads to poor performance when the strategy is applied in actual trading environments. You don't want to fool yourself. What are simple ways to prevent overfitting? To prevent overfitting in trading and backtesting, you must use few parameters to simplify your models, as complex models and too many rules can learn the noise in the data instead of the actual signal. Also, divide your data into separate sets, one for training and another for validation. This helps ensure your strategy works on unseen data. What role does data quality play in overfitting? You've probably heard the expression garbage in equals garbage out. This applies to backtesting. If the historical data is inaccurate or noisy, the model might capture these errors instead of genuine market signals, leading to poor performance in real trading. High-quality data helps ensure that the model learns relevant patterns, increasing accuracy. How do I choose the right amount of data for backtesting? To choose the right amount of data for backtesting and trading, you must aim for a balance that covers various market conditions. This typically means using several years of data to include different economic cycles. You must make sure you have included both bear and bull markets. This is important because using too little data might not give you the complete picture. Additionally, always consider the specific assets and time frame of your trading strategy. What's the difference between in-sample and out-of-sample backtesting? In-sample backtesting involves optimizing and testing a trading strategy using only the first part of your historical dataset. The remaining part of the dataset is used for out-of-sample testing. Out-of-sample backtesting is when you use the trading rules obtained from the in-sample test and apply the rules on the last part, which is unknown data. By doing this, you see how well the strategy performs on future unknown data. This helps verify if the strategy has predicting power or happened due to luck or chance. Is it better to use fewer parameters to avoid overfitting? Yes, using fewer parameters can help avoid overfitting in trading and backtesting. As a rule of thumb, you should always use as few parameters as possible because you want to have simple strategies, not complex ones. Many parameters explains the past, but are less likely to predict the future. When faced with a problem, people tend to select solutions that involve adding new elements rather than taking existing components away. This way, we add more complexity to a solution when we should reduce it. Beginners believe they need to find something that's advanced to succeed, but it's often the opposite. Profitable trading is more about finding simple strategies and following the plan. It doesn't need to be the best or optimal plan, but the simplest plan that you're able to follow and execute. What are common signs of overfitting in backtested results? Overfitting in backtested trading results occurs when a model performs exceptionally well on historical data, but poorly in live trading. Common signs include very high returns in backtesting that aren't replicated in real market conditions, and the strategy's performance deteriorating when applied to new unseen data. This suggests that the strategy is too closely tailored to specific past conditions rather than capturing true market patterns. What are practical tips for avoiding curve fitting? To avoid curve fitting, use a simple model rather than one that's complex. Split your data into separate sets for training and testing, ensuring the model performs well on unseen data. Limit the number of parameters you optimize, as more parameters can lead to models that fit the noise in your data rather than the actual signal. Regularly reevaluate your model with new data to confirm its effectiveness. Can too much data lead to overfitting? Yes, too much data is likely to lead to overfitting. This makes the model excellent at predicting past data, but often poor at forecasting future, unseen market conditions because it's too tailored to the historical data it was trained on. Can too much optimization lead to curve fitting? Yes, excessive optimization can lead to curve fitting. The strategy becomes too specific to the historical data, losing its ability to generalize and adapt to new market environments. That said, strategy optimization is important because you get a grasp of the robustness of your parameter setting. Thus, optimization is a part of backtesting, but you need to know what you're doing. How can I use walk-forward analysis to combat overfitting? Walk-forward analysis helps prevent overfitting by continuously testing the strategy on new, unseen data. Using this approach, you develop your strategy using historical data, then test it on a subsequent dataset, updating it periodically. This ensures the strategy adapts to changing market conditions and maintains its effectiveness over time, reducing the risk of errors that occur when a model fits too perfectly to old data. How does transaction cost impact overfitting? Transaction costs can increase the risk of overfitting in trading strategies during backtesting. When backtesting, if these costs are ignored, a strategy might appear more profitable than it really is. By including transaction costs such as fees and slippage, the real-world effectiveness of the strategy is more accurately assessed, which can help prevent overfitting. In today's markets, commissions are almost zero, but slippage is a much bigger issue. However, the transaction costs vary from asset to asset. You can't use the same cost estimate for an illiquid stock and SPY, the ETF that tracks S&P 500. SPY has transaction costs that are close to zero, while a stock might have much higher costs. We suspect many traders throw away good strategies for liquid assets because they use too high estimates for transaction costs. How we deal with overfitting in trading strategies and backtesting. Backtesting is an important tool. We believe it's the best estimate you get on future profitability of a trading strategy. If you are interested in this topic and want to learn more, you might be interested in our backtesting course, where we go through everything that's important about backtesting and curve fitting. We've even included a trading strategy in the course. You'll find a link below the video. That's all for today. Please like and subscribe if you like the video.